So we're going to talk a little bit about trading more complex Wyckoff accumulation and distribution models. So when I say more complex, I'm referring to the fact that we know, based on the range lessons, that you can absolutely have ranges within ranges. We know that every range either breaks up or it's to break down and will not continue sideways for eternity. So knowing that and knowing what we know now about Wyckoff, we can realize that, hey, there's a high probability that we are going to have these Wyckoff models within Wyckoff models. So what I have drawn on my screen here is an example of what I'm going to call a 12-hour Wyckoff distribution model, where we have a model 2 in the making here, essentially breaking down at the end. Whereas the initial tap 1, or the buying climax of such a model, is over here. And the upthrust is over here. And then the third tap is right around here. Okay? So we're looking at that. We can also call this entire thing the third tap. Why? Well, because we're looking at this more from a supply range perspective, meaning that this entire zone here is the supply range following the break of market structure from left to right. So I'm going to run you guys through that very quickly here, just so you can understand how this really progresses, because you will see this quite often on whatever asset that you're watching, okay? You're going to see these models within models. It's a very common behavior in any market. Now, of course, you really got to ask yourself, should I be playing these models? Well, yes and no. So if it's too tight of a bigger time frame range and you feel that, there's not really a whole lot to this range, then maybe you'll pass on that and you'll trade the bigger model here as a whole, right? You'll trade these two taps here, ignoring the first tap always. But let's say that it is a bigger model, or a bigger range rather. We'll call this like a $2,000 range on Bitcoin. It's a pretty big range. And within that range, we're looking at the extreme zones, the extreme discount, which is the bottom 25%, and the extreme premium, which is the upper 25%. If you see these Wyckoff models develop themselves in those two areas, then absolutely take advantage of it if you think you can. Okay? Why not? Why would you not take advantage of that? Now, of course, you're going to have these models present themselves in areas, in these general retail areas. So I'm going to throw the scale tool on, and I'm looking at anywhere in this black box here, okay? This is what I call the general retail area, or the general value area of a range. So anything that's strictly confined to this area, like this zone here, or this model here, then perhaps not, right? Perhaps we're not going to touch those, because a lot of the time you can have these funky models develop, especially if there's no reason or true valid reason why they're developing in the first place. Like, really, do they matter? Like, did this do anything significant at all for distribution? Probably not, right? Because price ended up going higher anyways, right? You got to ask yourself that. Like, for example, am I going to be shorting a distribution in the middle of the range if this is all that I see? If this is all that I see so far, then the answer is no. Why? Well, because I can tell you the swing high developed itself, the swing low developed itself. We confirmed the range right here, sure. We were playing around in the bottom of the range with the Model 1 accumulation schematic right here. But ultimately, it stopped halfway up at the range, a little bit past the 50% line in the retail premium zone right here. Just to do what? Just to distribute already? Does that really make sense? Not really, because what if this was like a zone that made sense to distribute from on the 4-hour or 12-hour like we talked about? Well, then why would it stall out here without ever taking out this high? That doesn't make a whole lot of sense to be shorting here, does it? Based on that context. So no, I wouldn't look to short this little zone here. Would I have long this zone? Absolutely. Why? Because I know that it makes sense to rotate back up again. We've been hovering around this side of the range. We haven't seen this side. And if this is to be a distribution, the high of the range has to go. It has to be swept out at some point in time. So anticipating that, then why would you not take advantage of the extreme discount, right? After confirming. That's silly. Of course we're going to, right? So this is even though it's kind of hovering in that zone here a little bit, it popped in a little bit. Yeah, sure. But the majority of that range is actually not in the retail zone, which is fine. I'm great with that. That's cool. So in this example, as you can see, I drew up quite a bit of models. It's very unlikely that you're going to see this many in a quick, 4-hour, 12-hour range. But in this example here, we're going to say that actually happened. Okay. We're going to pretend that it happened. And what we're seeing here is a complex version of Wyckoff, right? So we have a swing high form. We got our swing low. We got our confirmation of the range, obviously. Price then came down and formed a swing low with a swing high. I'm going to draw that in with our range. After forming that swing low to swing high, it swept the low, but it didn't break any structure. The structure that I was watching was between here and here. It remained bearish. Let's pretend that structure looked like this. Down, up, down, right? So obviously this high is lower than this high, so it didn't break anything. So we were assuming a model 1 was likely. So we dissected the last leg here, and we've seen a structure shift. And as soon as we got that structure shift after the reclaim of the range low, we decided to market long, putting our stop below this low, targeting this initial high, targeting that high, and then targeting the high of the range. So we therefore held on to that long trade up towards the range high. We've seen a few distributions along the way that ultimately ended up with a manipulation phase. You had a distribution here, which was a swing high to swing low. It looked all fine. Everything looked fine and dandy. But the objective of the distribution was to do what? Well, the objective of this distribution was simply to reaccumulate, possibly mitigating remaining demand over here for that higher low for the next higher high from an internal standpoint. So the internal structure is swing high, swing low, swing high, swing low, swing high, swing low, swing high. So as you can see, the objective of this distribution model was only to trap traders on both sides here to pull price up higher and to mitigate demand over here on the left. Demand also being known as a demand range. This whole thing was a demand range. So price did just that. And then price decided to make its way up towards a high. During the last spike here, where we made that next higher high, it decided to produce one more accumulation model 1 schematic, possibly enticing traders into believing that it was going to blast much, much, much higher. Is it wise to long into extreme premium pricing? I hope the answer that you just said in your head was no. We should never be looking to long, even if there's a Wyckoff model present, within a larger range or larger model in the extreme opposite end. So if you're looking for longs, you should never be longing up here. You should never be shorting down here, regardless of whether or not something like this presents itself. Unless you're a pro trader, then don't touch that zone at all. So there was a zone here, but of course, those traders were fooled very quickly because what happened instead was a second tap of the bigger Wyckoff model. Price then came in and it broke structure bearishly, breaking that previous model 1 accumulation low right here. Broke across left to right. We have that bearish break in structure. What follows was an aggressive move to the range low. Okay, we have this very, very aggressive move. Lower low, lower high, lower low, lower high, lower low, then shift. As you can see, there was a reason for this shift. Why? Well, the reason for the shift here was quite simple. Even though it wasn't quite an accumulation model per se in the squared off area, what we had was a range-bound environment or a demand range. So you would have had this demand range that you could have entered on following that transition in market structure. Hopefully you watched the structure from this high expansion down to break back to bullish before entering again. But ultimately it did what? It actually ended up forming yet another model 2. You had the swing low form. You had your swing high form. You had the confirmation of your range. Let's draw the range in. Okay, so we have those 3 points. All is fine, all is well. And then you swept the low. After sweeping the low, price decided to come up and break the range high with a candle body close. Therefore, it made sense for a higher low, for a higher high. Where would be the next logical target for such a model? Well, the next logical target would be the supply range. Why? Well, because we broke the structure of the range itself. Let's draw that orange structure in again. Higher high, higher low. Higher high, higher low, higher high, higher low, higher high. Bearish break 1, bearish break 2. You didn't really need this one, but it was extra confidence for me. So we broke structure in the uptrending nature, which therefore meant it made more sense to make a model 2 distribution than a 1. So what happens? Well, price decided to come up into this newly formed supply range. We'll put that in red. When price nipped into that supply range, perhaps there was also an order block with imbalance that was remaining right about here. We'll put this in, I guess we can use blue. So it just missed the order block with imbalance / fair value gap fill on the first peak of that range high. So guess what happened? We formed yet another distribution model. So the price action formed yet another distribution model in the process. So you had a swing high form, a swing low form in an uptrending environment. That's why we pull high to low. And then we had the confirmation. Then you had a sweep to follow into the order block with imbalance, a market structure shift on a lower time frame, which allowed us to market in with a stop above that high, and a target being this low, and then this low, and then a lot lower. Ultimately, producing itself as the third tap in the bigger model. So we have our 1, we have our 2, we have our 3. We have hit the primary target being the range low, and then using what we know, we decided that it made sense that price action could very well go substantially lower because there was a fair value gap fill at this line here. Price action decided to produce its way down very aggressively and hit the target. So that's how I would play a complex Wyckoff model. Obviously, it's not always going to be an identical example to this. I try to make it as realistic as possible, of course. This is very, very advanced, okay? Very, very advanced. So if you're not comfortable with everything else in the course, move on from this, okay? Definitely move on from this. Come back to this later on when you feel like you're ready for it. You will see these complex models. You will definitely have them across the board. They're all over the place, right? And in the next clip, I will show you guys an example of an actual complex model.